Hey everyone, John Henry here, slingshotfutures.com. Today we're going to be talking about a very hot topic, if you will, and that is trading gambling, right? Is this gambling? Well, the short answer is yes, that is what you're doing. Everything you're doing is on a probabilistic scale. You're putting money in hopes of making more money come out. So on the surface, it does seem very, casino-esque. But really, when we're talking about the edge, if you will, because one thing that always comes up when you're talking about casinos and gambling and all of that is the house edge, right? Well, this is where the big difference comes in between trading and casinos. Casinos always have the edge, right? They always have the edge because, well, they have to make money. That's what they're there for. If they didn't have the edge, everybody would play that one game and make all the money and put that casino out of business. So when we're talking about casinos, you're looking at some of the best odds in the casino. Like blackjack, you have a chance of 44 to 48% to win. On craps actually probably has the best odds of success in terms of casino games that you can get in a casino. At sometimes the house edge is 0 or just above 0, all the way up to like 16 and some odd percent on craps. So you'll see very quickly that the house edge, well, there's a reason they call it a house edge, because they have the edge. They're the ones that at the end of the day, over a long enough string of samples, they're the ones that, based off of math, are going to make money. Now, the big difference that we're going to run into here is that as a trader, we have the ability, or at least the potential ability, to put something in our favor. We have the ability to become the casino, right? We're the ones with the edge if you're trading a specific trade plan that allows for that to happen. Now, what do I mean by that? Well, when we're talking about probabilities, right? If we compare probabilities and just look at 3 different scenarios, right? So you have 3 different scenarios that are setting up here. And this is just on the surface base, not taking context or anything into example. This is just purely probability, right? And you know me and probabilities, big fan. If we're talking about standard house edge stuff like we're talking about in casinos, then we're looking at like a 40% chance of success. And then we have our standard 50-50s, and then we have 60% and above, right? So 60% and higher. So the casino generally is over here, right? This is the casino, right? They're the ones that have a better chance of winning, and this is generally you. Now, the difference here is that with us being traders, we can choose which one of these we want on the surface. Again, not taking into account any external factors, just looking at probabilities. If we look at this and say, okay, you know what? I'm going to buy right here across the board, right? This is my buy line. I'm going to buy right there. Well, if I place a stop, oops, that's not what I wanted. If I place a stop right here, and my target is right here, the chance of success is going to be 40%, sometimes even lower, depending on how close. Because if you look at the overall scenario, and I just closed it all, it's going to be much easier for the market to go down than it is up. Give me 1 second here. Let me just redraw all my pretty drawings here. So we have 40%, we've got 50%, and we have 60%, or the casino. So again, we have our entry line right there, and our stop is going to be on the 40% example right here, and our target is going to be here. Now, the reason that this is going to be considered lower probability, because, well, statistically speaking, it's much easier for the market to go down to your stop than it is to your target. Your stop's closer to the market. Therefore, the probability of the trade is never going to be very high. It's always going to be easier for the market to move less distance. It's just kind of common sense. That's how the math works in this case, regardless of where you're entering. If your stop is hyper close, it's going to be, statistically speaking, or at least probabilistically speaking, lower probability. It's going to be easier for the market to go down into your stop than it is to go up into your target, which is totally fine, as long as you're trading it correctly. If you're taking a 40% scenario with this type of risk reward, in the long run, you're going to be making money, right? So this is how we can skew things to our advantage. If we're looking at a 50-50 trade, you'd be thinking, okay, well, I'm going to go for a 1-to-1. My stop is here, and my target's here, bingo bango. That's not the case. Remember, we have the slight disadvantage of having to calculate commissions. So if you were going for a 1-to-1 and you were right 50% of the time and wrong 50% of the time, you make 10 and you lose 10. But you're not losing just 10, you're losing 12, right? Because you have commission to pay. So because of that, we cannot go for a 1-to-1. It does not make any sense. So what we have to do instead is alter a little bit and go for a little bit more. At least 1.5 to 1, right? 1.5 to 1 to Z, apparently. This one you're looking at 2 to 1 or better. 1.5 to 1 or better. This way, we can be 50% accurate and still at the end of the day, end of the week, end of the month, end of the year, be making money. That little difference, even 1.25 to 1.5, somewhere inside of there, is generally where you want to be at a 50%. And then if we're looking at the final example, thank you, Google Drive, for closing my drawing again. If we look at the final example is the skewed variant, which is how the casino would love you to play. Which is using an entry point, I'll just do it this way, an entry point here, a stop here, and a target here. Now, probabilistically, it's going to be very likely that you're going to get your target hit. It's a very high likelihood that you're going to be right on the trade because, once again, just like if we inverted this, it's easier for the market to move that smaller distance to your target than it is to your stop. And this is the situation that casinos put you in, right? So you're in a situation where, although you may be high probability, you may be running into a situation that your risk is just exponentially larger, right? You could be risking 3, 4, 5 to 1. So the times that you win, you're winning. You're hitting all these wins really, really well, but then you take that loss and it wipes out 4 or 5 trades. Again, this type of situation, there's absolutely nothing wrong with. There's nothing wrong with this type of trading as long as you're proficient enough to get above the bracket or above the math, essentially, where you're negative, and that's 60% higher or higher on the accuracy. And that is all variable based on the stop. So that's one of the biggest differences when we're talking about gambling as trading. On the surface, yeah, pretty much seems like that, right? Let's just go to the casino, throw it on red or black, and see what you come out as. But that's not the case. We make our own odds as traders by several different factors, by looking for correct location in the markets, by skewing it with our risk-reward, assuming the correct probability on the trade in accordance with the risk-reward, right? The issue with casinos is that, well, you have a chance to win at blackjack 44 to 48% of the time. But you're only winning as much as you put in, right? We were just talking about that in that 50-50 example where you're going to be losing money, right? If you're winning 48% of the time, but you're only making back what you can, what you put down. So if I put $50 down, I get $50 back unless I get a blackjack, and I get a little bit more. That might offset it a little bit, maybe to 49.5%. But you're still off by that 0.5%, and over the course of a huge amount of trades, over the course of a year, you're still losing, and that's where the casinos have the edge. So we need to shift that edge. Look for the correct locations. Look for the correct context of the markets. Look for everything to be lining up in your favor, following your game plan, and then place the trade, and even then, potentially look to make more than you're willing to risk. You are then essentially becoming the casino. The edge is in your favor rather than everybody else's, and that's the biggest difference from the way that I see it. So that's going to be taking a look at, is trading gambling? Yes, no, kind of, sort of. It depends on how you approach the markets. And hopefully you found it useful. Hopefully you found it interesting, something entertaining, and something to consider when you're looking at your stop placement versus your target placement, as well as the probability, the location that you're taking the trade, etc. All of those things are allowing you to be the casino if you're patient enough to wait for them. So that's going to do it for this one. I hope you found it useful, entertaining, interesting. As always, underneath the video, make sure to throw us a thumbs up, show us that you like the content, and of course, subscribe to the channel so you don't miss anything important. Click the little notification bell to the right of that subscribe button as well, so that way, if you, for whatever reason, the YouTube algorithms are a little bit weird, don't see one of the videos pop up in the news feed. When you're notified using that little bell icon, it'll shoot you an email every time one comes out, so you won't ever miss anything important again. That's going to do it for this one. I hope you had a fantastic trading day today, and we'll see you all in the next one. Thanks.